Adam Parker. He's the CEO and founder of Trivariate Research. He is here with me at Post 9. What do you make of this? What do you make of this turnaround today and what Josh was talking about, too?
Well, I mean, look, Josh is a better market watcher than me. You know, I'm a research nerd, right? So we don't really make the 1 week calls. And so I'll defer to him. He's got a good 1 week wrap.
But you could speak to the broader issue of, you know, what Powell's likely to do this week, whether it's going to soothe or upset the market, whether it's going to be a shock, or if he tells us what we already think we know.
The reason I answered that way is because what happens over the next week is different. Ultimately, they're going to be wrong, and inflation's going to be stubborn. I know that.
You don't know that.
I do know that. Because the CPI is 32% owner's equivalent rent, and rents are continue to be pressured higher. Why? Because if you think about housing as a 2x2 grid, Scott, right? High home prices, low home prices, high borrowing costs, low borrowing costs. Which quadrant are we in? High borrowing costs, high home prices. We haven't had a lot of transactions yet. And so if you're a new buyer, you're a young guy, right? You're going to say, you know what? I'm going to rent for a year or two because I got to either have the 30-year fix come down or home prices have to come down. So there's actually, I just was at a conference 2 weeks ago. Everyone is saying they're still taking almost 1% per month pricing. So the CPI is going to remain elevated for a long time. If it just started to get flat today, man, it would still take 11, 12 times raising 1% a month. Zero. It's just going to have a lot of upward pressure.
How's the Fed going to raise rates?
I don't know what these guys are going to do. They were buying billions of dollars of mortgage-backed securities.
I know you keep saying that every time you're on.
They have no idea. So the point is they have no idea. How
what difference does it make? So they made a mistake before. Does that mean that they have no credibility for here to perpetuity?
It means they're going to keep raising rates so they control inflation much more than they have. Inflation's been stubborn in other spots besides just housing, but it has been in housing. So I think they're going to continue to be hawkish. Maybe they won't be incrementally hawkish this week. That's possible, and you could get a little relief rally. What I find hard in any medium to long-term view is what makes them more dovish is earnings come down, right? So if I think about the stock market as the price to earnings times the earnings equals the price, I have to be sustainably bullish because the PE is going to expand because they get dovish. At the same time, my view of earnings is really declining a lot.
Well, what if earnings
What
if earnings don't come down as much as you think they will?
I wrote about this week. I think I sent it to you overnight. I think what I'm starting to sort of warm to is the fact that this decline in earnings won't be short. It could maybe last into 2024. So investors who build models to predict earnings and revenues for stocks, they think out 6, 12 months and say what could be worth. If everyone I know has 2024 earnings above 2023, well, what if that's wrong? What if the consumer's been stubborn but starts to slowly unfold here over 6, 12, 18 months? Because we see a little bit of wage decline into next year as there's more firings, and we see a little bit of firing and unemployment rise next year, and the Fed starts saying, all right, it's working. I think what Josh said I agree with is it's not like they started in March and we've seen the full impact of it now. It's going to take multiple quarters. So I think that'll be interesting to see. Maybe the consumer will slow into 2023 and 24, and all of a sudden my assumptions in every one of my models that every analyst has in the street is the numbers are way too high to justify the valuation.
If it takes that long of a runway to get to that point
in the next week, of course we could.
No, forget about the next week. I mean, let's talk about the next handful of months.
Right.
If it's going to take that long in your mind for the consumer to start to really roll over, for earnings to start to come way down, what happens in the interim? That's a long runway of time.
I honestly think, you're 3,900, as you said. I give you.
Yeah, we're like right there.
Right. I think we're plus or minus 7-8% here over the next 3-4 months. It's hard for me to get out of that range. I think when you get to the upper end of the range, you're going to worry about quantitative tightening, a hawkish Fed, and earnings that have to come down. When you get to the bottom, you could say positioning and sentiment. The one thing that I might have disagreed with Josh on, and I largely agree with him because, I think we look at a lot of the same metrics, but I would say that I don't think people are as positioned anywhere near as negative as the rhetoric. You and I have been talking about for a while. Look, everyone knows earnings are too high. Everyone's kind of negative. But if you really look at hedge fund exposures or retail flows, the banner is negative, but people aren't really positioned that negatively. So I don't know how much of a influx positive flow argument we could get over multiple months. It could be a couple weeks, but I don't think it'll be a massive inflow.
There are some who suggest that bonds are now the best game in town.
Yeah.
Right? I mean, that's what Gundlach told me last week. If you really want to go for it, and you should, this is his words, my advice is to sell stocks and buy opportunistic bonds. It was brutal to be a bond investor for the past several years. Now it's actually the place to be.
I think we've talked about it. I like the 2-year bond. I mean, if you're managing a portfolio or you're looking at your own assets, Are you sure? You get almost 4% now on the 2-year for the next 2 years. You're sure you're going to beat that? You put some money in, you get 3.9% a year for the next 2 years. I think that's a lot more compelling than it was 6, 12, 18 months ago.
There must be a layup then, because everybody's talking about the 2-year being the best place to be right now. Is it really that easy?
I just think it's guaranteed by the U.S. government. So yeah, from that standpoint, it's easy. I think what people aren't maybe talking about, two things. One, the sustained impact of an inverted yield curve, meaning that 2 years above the 5 is above the 10. Historically, that is a mixed cocktail for equities. And two, and Josh talked about this a little bit with semiconductors, I think it's important to look at inventory levels right now and understand, are we really going to have too much product out here into the fourth quarter? And I think that's of note.
So Scott Minerd was on earlier today in the exchange and suggested there was a once-in-a-lifetime opportunity. And by the way, he's negative on stocks, right? He thinks we're going to go down 20% between now and October.
Okay.
Once-in-a-lifetime opportunity in highly levered unicorns, he said. Time to bet selectively on high yield, great companies with nonsensical capital structures, at least 30 to 50 such stocks on the market. Now, he was not going to reveal the specific names, sort of suggested that we all should know exactly what they are. What are highly levered unicorns in your mind right now?
Well, I don't know if I look empirically at our database and study the history of returns, I'm not sure we've ever had a period where 30 to 50 stocks have gone up a lot when the market was down 20. So I don't think there's any evidence that you could find that. I suppose what he means is people will be able to isolate securities that will have a lot of underappreciated growth. I think you need a dovish Fed to get the price to earnings or EV to sales ratios to expand at the same time.
But do you think there have been, as a result of the environment we're in, asymmetric declines in stocks that don't deserve to have come down as much as they have? Or if they have, it's still worth buying some of them anyway, because they are these unicorns that he describes.
I think it all depends on horizon, right? I have a friend who just had a baby the other day, was allocating the 529, and I thought, well, yeah, in an 18-year view, you sure as heck want a lot of growth and ability. You don't want to be negative on tech and healthcare in a long-term view just because you're in a negative moment for 6 months when your kid was born. Right, so I think it depends on your horizon. If you look out 2, 3, 4 years, of course you're going to want some highly, high quality U.S. growth companies in your portfolio. I think the question is over the next 6 months, when the Fed's going to be hawkish, when CPI is going to be high, when the numbers are way too high, that's a trickier risk reward in my view.
All right, let's bring in Katerina Simonetti of Morgan Stanley Private Wealth Management, a CNBC contributor, Brenda Vingiello of Sandhill Global Advisors. It's great to see both of you. Katerina, your reaction to this call, if you want to call it that, from Josh Brown, that you could get an interesting move here into and out of the Fed meeting?
Well, Scott, there is a lot of risk in this market and not much reward for the upside. And this is a reality. And that's why looking at the equities and leaning defensively, leaning strategically towards the dividend yield and looking at equities that deliver strong cash flow, high dividend yields is so important in this inflationary environment. And we prefer sectors like healthcare, financials, REITs that historically have been paying a decent amount of income and can serve as inflation hedge. And, Fed is going to do what they are going to do. There is going to be some type of a lag between the Fed action and the desired outcome. And the question is, are we going to get a recession and how severe it's going to be? And based on that, we will need to figure out how to proceed. But the earnings risk is very significant and market is not taking it as seriously as it needs to be. And that's for sure.
So, Brenda, Katerina says the Fed, I'm writing it down, the Fed is going to do what the Fed is going to do. Maybe it's not. Maybe it's not going to be able to do what it ultimately thinks it has to do for a variety of reasons. The economy notwithstanding is the principal one.
Yes, and I think we'll certainly learn a little bit more on Wednesday. But I would say, over the last couple of weeks, the sentiment has felt a lot like it did back in early to mid-June, where there's a lot of concern about 2023 earnings and what those might look like. And there's a lot of concern about what the ultimate path of the Federal Reserve is going to be. But I think this time around, we're going to have a press conference, which is important. We didn't have that after Jackson Hole. And so in that, there's typically an opportunity for the Fed to reiterate that they're data dependent, that they're going to keep watching what's happening in the broader economy and take that into consideration. And I think that's an important secondary message here. But I agree with Josh in that well, I hope that we do have a rally. I'm not banking on that here in the short term, but I do agree that we are closer to the end of this rate hiking cycle. And so if we think about the end of the year is just 3 months away, it's not very far from now. And I think if we can get there and the market then has clarity on what things look like going forward, even if we continue to see weakness, which I think we will in many of these sectors that were huge pandemic beneficiaries, things like consumer goods, housing, all of these groups really benefited tremendously over the last few years. So we've had, just a return to normalcy in terms of trend. And in some cases, that might mean that there is a year-over-year decline. But these have also been areas of huge sources of the inflationary pressure that we've been seeing. So this should contribute to helping with the inflation problem that we've been seeing. So we might find that doesn't have to do as much.
Yeah, unless AP, we are setting ourselves up for a fake out, like after the Fed meeting the last time, where there was the prevailing view was that he said we're getting closer to the end, right? And then the CPI came out and was like, maybe not, right? And the market started to project a much more hawkish outlook, much more than people had expected. 75, for example, this week, followed by 50 and then 50, rather than, okay, maybe it's 50, 25, 25. How about this view?
I mean, look, we're definitely closer to the end than we were. I mean, I think that's for
Better
sure.
Be.
Yeah.
We got bigger problems.
Right. I think what I'm struggling with is, again, I'm supposed to be more bullish when they get dovish. At the same time, it's more obvious the economy is massively declining and earnings are impaired. And so it's hard to just say earnings completely don't matter. All you care about as an investor is, do they get directionally dovish or not this week? That's a 2-day or 3-day algorithm.
Where you been for the last 14 years?
But Fed fund futures have really only mattered for the last 6-9 months as we've gotten more anticipated. You're telling me at all that earnings next year don't matter and they don't matter? You're not saying that. I'm saying...
No, I'm not saying that at all.
There's a trade on Thursday or Friday based on this. But if we look out to Q3 earnings and everyone says, things are starting to slow, we look out in January, things are slowing material, we're firing. It doesn't matter, what happened, if it's 25 and 25 or 50 and 50. What matters is they've decimated the economy. I think the reason why they will get more dovish eventually is because they finally will have caused a pretty big recession.
You think they are going to decimate the economy?
I think they have no choice. Yeah, I think they will.
So Katerina Minard, who I referenced earlier, Scott Minard, of course, said that Fed raising rates is going to, quote, end in tears for investors. Do you agree with that?
Fed is going to react to the data that
the Fed. Say that again. I'm sorry, I couldn't hear you.
Federal Reserve is going to react to the data. It's a data-driven Fed. And in my opinion, the rate hikes that we're seeing have already been incorporated into the market. I don't think that we're going to be surprised by anything they're going to do. I think that the real news to watch here are going to be earnings that have been declining, and they're going to be revised to the negative. And that is what is going to bring that next leg down in the market. And this is something that investors are, if they're not concerned about yet, they should be concerned about. And that's what we need to be preparing for, because things might get a tad bit worse in the equity market before they start getting better. And this is tied directly to the earnings revisions. Once earnings are revised and we can move on to the next bull market, that will be the positive news, but we're not quite there yet.
You're advising wealthy clients, Morgan Stanley Private Wealth. Are you advising them to look to fixed income over stocks right now?
Well, Scott, fixed income definitely offers safe haven, especially short-term, high-quality corporate debt is looking so much better. And this is a nice relief that there is a place that investors can go. But we encourage them strongly to stay within equity market, strategically lean on defensive sectors, look at yield, make sure that the asset allocation is appropriate, because the bear market that we're experiencing right now is going to come to the end, and we need to be positioned appropriately in order to take advantage of the recovery. And we're not there yet if we're sitting in fixed income, even though we're getting slightly higher yield, which is nice, but the yield is not adequately covering the risk of inflation. Inflation is really high. So we need to stay invested, but we have to do it in a very smart, strategic way.
Last and brief to you, AP.
Sure. I think it's hard for equity investors to buy those defensive stocks just because they look really expensive. They're bid up. So I find people are sort of owning them for risk management reasons, not alpha. And then really what they're looking for is some underappreciated value thing that could maybe recover in a dream next year. I don't see people as positioned that negatively, you know, and I don't see people wanting to own a lot of the defensive stuff. So we'll see how it fleshes out, but I agree 100% that the earnings will come down, and I don't like the logic of just because everyone knows it. It's just because I'm sweating in here because it's hot. Everyone knowing that doesn't make me cold. Okay, so
maybe
everyone
you're
knows
feeling the heat. I'm not sweating at all.
I don't know. It's maybe just being with those beautiful glasses that are making me hot. I don't know. Yeah.
All right, I'll see you. That's Adam Parker.
Good to see you guys.
Ladies, thank you as well. That's Katerina and Brenda joining us here. We'll talk to you again soon.